In 1976, there was just one index fund to choose from, the 500 Index Fund from Jack Bogle's newly formed investment firm called Vanguard. Today, there are hundreds of index funds and thousands of index portfolios to choose from. Small Cap Index Fund, Emerging Market Index Fund, Healthcare Index Fund. You name it, there seems to be an index fund for one. So how do we filter out the best? To help you with that question, I've compiled what I consider the best index funds in the market to help you construct your ideal investment portfolio. And real quick, if you just want the list of funds, you can skip to the recap portion of the video or just review my list of funds in the description below. And if you're new to the channel, welcome. My name is Tay, and in this channel, Financial Tortoise, our primary focus is on learning to grow our wealth slow and steady. Before we dive into my favorite index funds, for those of you hearing this term index fund for the first time, let me give you a quick primer. Index funds in a nutshell is this. Instead of hiring an expert or spending a lot of your brain bandwidth trying to select the right stocks, you just invest in a good low-cost index fund that tracks either the total market, the S&P 500, or any segment of the market that you choose. For example, an S&P 500 index fund matches the 500 largest publicly traded companies in the United States. A total stock market index fund replicates all the publicly traded companies in the United States. At the time of this video, there are approximately 4,000 publicly traded companies in the US. A total international index fund replicates a broad cross-section of thousands of reputable international stocks from both emerging and developed economies. With a small management fee for each fund, ranging from 0.015% to 0.11%, you can be invested in an index fund within minutes. And indexing, in many experts' opinion, is really one of the best ways to invest because they have and will continue to outperform the thousands of actively managed funds over a long period of time. Alright, with that said, what specific funds are the best? Let's first start out with index funds that track the total stock market. As mentioned earlier, there are approximately 4,000 publicly traded companies in the US. These range from big boys like Apple, Amazon, and Google to thousands of you might have never heard of because they're so new or they specialize in a very specific market. And when you invest in a total market index fund, you get the maximum benefit of diversification. And diversification is really the best way to mitigate your risk in investing in the market. The fastest way to get rich overnight is to own the next Netflix. However, the fastest way to lose all your money is to own the next blockbusters. To know what companies will do well or not do well is nearly impossible. Therefore, you want to diversify as much as possible, and it doesn't get any easier than buying the whole market. Alright, what are the specific funds? I'm going to give you recommendations from each of the most popular investment firms in the market: Vanguard, Fidelity, and Charles Schwab. Let's start off with Vanguard. My go-to total stock market index from Vanguard is the Vanguard Total Stock Market Index Fund, also better known as VTSAX. If you watch any of my other videos, you know I'm a big fan of this fund. It is where I keep majority of my money, and I don't plan on changing anytime soon. It has an expense ratio of 0.04%, which means if you have $10,000 invested in VTSAX, you're essentially paying Vanguard $4 annually to manage this fund for you. VTSAX also tracks the CRSP US Total Market Index, which aims to replicate the entire US total stock market, including large cap, mid-cap, small-cap, and micro-cap stocks. This is an index I personally believe is the most comprehensive in the market. If you're invested with Fidelity, I would recommend the Fidelity Total Market Index Fund, also known as FSKAX, or Fidelity Zero Total Market Index Fund, also known as FZROX. Both have really good expense ratio at 0.015% and 0% respectively. The Fidelity Total Market Index Fund, however, is the older of the two, having been founded in 1997 and tracks the Dow Jones US Total Stock Market Index. The Fidelity Zero Total Market Index Fund tracks the Fidelity's in-house index, Fidelity US Total Investable Market Index, and is a new kid on the block. Released in 2018, it really was created as a way for Fidelity to attract new investors into the Fidelity ecosystem. But it has some restrictions as regards to transferability, so you want to make sure you plan on staying with Fidelity for life before deciding to go with FZROX. Lastly, if you're invested with Charles Schwab, I would recommend the Schwab Total Stock Market Index Fund, SWTSX. With an expense ratio of 0.03%, is slightly less than Vanguard's VTSAX, but more than Fidelity's FSKAX and FZROX. It tracks the Dow Jones US Total Stock Market Index, and it has been around since 1999. One thing you might have noticed here is that I'm not talking about ETF equivalents. For example, VTSAX has an ETF equivalent called VTI with a lower expense ratio of 0.03%. My only qualms about ETF is that you can't set up automatic investments, or yet anyhow, directly on the investment firm's portal. Maybe I'll change in the future, but for now, that's my only qualms with ETFs. If you watch any of my other videos, you know I love automation. I don't trust myself, so I love to set it and forget it and let the system do the heavy lifting for me. But if that doesn't bother you, in the big picture, you really can't go wrong with either index funds or ETFs. If you're a long-term investor, the differences really doesn't matter. They're identical funds. Alright, I know we aren't supposed to rely on past performance for future performance, but I couldn't help myself. So just for kicks, I ran the funds through a portfolio visualizer just to see how they did in comparison to each other. I also excluded FZROX given its short history. Going back to 2012, the past 10 plus year performance are as follows. Vanguard Total Stock Market Index Fund at 12.86%, Fidelity Total Market Index Fund at 12.84%, Schwab Total Stock Market Index Fund at 12.78%. The VTSAX is slightly better than the other two funds, but that's probably because of its index composition. Each company has their nuances on what index they follow and how they manage the ins and outs of the new and old companies. But in the big picture, the difference is so small that I would say negligible. When you look at it year by year, you can hardly tell the difference between these funds. The bottom line is that regardless of which investing company you go with, you really can't go wrong with any one of these total market index funds. They're very well diversified, cheap, and super simple to understand. Alright, moving on. Let's say you're more of a big company kind of a guy. You want the majority of your holdings to include the biggest companies out there, not the mid or small size companies. In that case, you want to hold the index fund that tracks the S&P 500 index, the Standard & Poor's 500 index, an unmanaged benchmark representing US large cap stocks. Unlike a total market, which includes every single company in the market, the S&P 500 only holds the 500 biggest companies in the United States. Now, you might be asking, is this better? Is this better than a total market? Why are there different indexes? You want the honest answer? Because Wall Street loves to overcomplicate things. Simple solutions aren't sexy and they don't sell stuff, but complex do. Some people prefer the S&P 500 over the total market because there's been time in history when the big companies outperform the small cap and mid cap companies. But for average individuals like you and I, it really doesn't matter because these two indexes are more alike than different. 80 to 85% of the total market is made of exactly the same companies represented in the S&P 500 based on market cap. So my recommendation is this. Don't think too much about it, just pick one and stick with it. I personally have both because my old employer's 401k plan didn't have a total market option and only offered the S&P 500. Whatever the reason, you can't go wrong with either the total market or the S&P 500. Just to emphasize this point, when we map out the performance difference between the total market versus the US large cap like the S&P 500 the past 50 years, going back to 1972, the average annualized return is identical at 10.32%. There were years when total market did slightly better than the large cap because small cap companies had greater returns. And there were times when large cap did better than the total market because big companies had better returns. But these are just period dependent outcomes. To know when this will happen again is like trying to predict when the next pandemic will occur. No one knows. Alright, enough with that rant. Let's get into specific funds. If you're invested with Vanguard, I would recommend the Vanguard 500 Index Fund, also better known as VFIAX. This fund is the OG of all index funds. The original version was created in 1976 and has been the standard bearer for all index funds that it inspired afterwards. It has an expense ratio of 0.04%, identical to VTSAX, and it tracks the Standard & Poor's 500 index. Given it has a long historical record, we can go back all the way to 1976 and calculate its annualized return. From 1976 until now, this fund had an average annualized return of 11.27%. Which means if we invested $10,000 in 1976 and held it without touching it until now, it would have grown to over $1.5 million. Now, don't we all wish we had a secret account like that somewhere? Alright, moving on. If you're invested with Fidelity, I would recommend the Fidelity 500 Index Fund, also known as FXAIX. It has an expense ratio of 0.015% and has also been around for quite a while. Not as old as VFIAX, but it was created in 1988 as Fidelity's flagship S&P 500 Index Fund. Given its long history, from a fund size perspective, this fund is actually the fourth largest fund in the world with close to $400 billion in assets under management, right behind Vanguard's funds that we discussed earlier. As regards to Charles Schwab, I would recommend the Schwab S&P 500 Index Fund, also known as SWPPX. It has an expense ratio of 0.02% and also has a slightly longer history than its total market counterpart, SWTSX, having been started in 1997. Alright, just for kicks, let's compare the historical performance of these three funds. Going back to 2012, the past 10+ year performance are as follows. The Vanguard 500 Index Fund at 14.39%, the Fidelity 500 Index Fund at 14.39%, and the Schwab S&P 500 Index Fund at 14.38%. Not a surprise given they all follow the same S&P 500 index. So if you like the idea of holding older index funds with the majority large cap companies, you can't go wrong with any one of these funds. Now at this point, if you selected any one of these funds that we discussed and you fund it consistently for a long period of time, you really can't go wrong. There's a very good chance you'll build sustainable wealth in the long run. However, let's say you want to diversify your holdings a bit more with some additional flavoring. You like the meat and potatoes of the US companies, but you want to add a bit more spice to your life. Maybe a bit of Indian curry, Korean kimchi, and South American pupusas. This is where international funds come in. If you live in the United States, you're likely familiar with major American companies like Apple, Microsoft, and Amazon. However, can many of us honestly say we know much about international companies like Taiwan Semiconductor Manufacturing, also known as TSMC, Tencent Holdings, or Samsung Electronics? Many of these non-US international companies rival the size of many major US-based corporations, some multiple times the size in market capitalization. TSMC, based in Taiwan, is single-handedly responsible for manufacturing 90% of the world's semiconductors. Tencent, a Chinese technology company, is considered the largest company in the world as regards to video gaming. Samsung, a South Korean conglomerate, owns the second biggest global market share of smartphones after Apple. When we're only investing in US-based companies by holding only US-based stocks, we're potentially missing out on the portfolio growth that these international companies can provide. US stocks provide great return on investment, but the US stocks still represent only about half the world's stocks. The total stock market value of the world is approximately $68 trillion, and the US company represents $33 trillion of that, or about 49%. If we want to look at an example that highlights the risk of holding stocks from just one country, we can reference the Japanese stock market. At the end of 1989, the Japanese stock market capitalized value was considered the largest in the world. The Nikkei 225 index, the index of 225 largest publicly owned companies in Japan, reached an all-time high close to 40,000 yen. Sadly, 22 years later, the Nikkei was under 8,500 and to this day has yet to reach its all-time high again. But sadder is a Japanese investor who failed to invest in international stocks outside of Japan. The US-based companies are currently the world leaders in market capitalization and revenue. But who can confidently say it will stay like that in the future? It would be unfortunate, but the same thing could happen to the US stock investors. I personally still have strong confidence in the US economy and the US-based companies as a whole, but I also have to continuously check my assumptions. Financial writer Larry Swedroe had a saying, "Never treat the highly likely as certain and the highly unlikely as impossible." Alright, with that said, if your worldview aligns with having some international funds in your toolkit, let's check out some of my favorites. If you're invested with Vanguard, I would recommend the Vanguard Total International Stock Index Fund, also simply known as VTIAX. The fund tracks the FTSE Global All Cap excluding the US index, and represents, at the time of this video, approximately 8,000 international companies. It has an expense ratio of 0.11%, which means if you have $10,000 invested in VTIAX, you're essentially paying $11 for Vanguard to manage this fund for you. Slightly higher than VTSAX or VFIAX, but we're talking about $11 versus $4. This fund aims to represent the market outside the United States based on market cap, so the good percentage of the fund is made up of developed countries like Japan, Europe, and Canada. However, what is also nice about this fund is that the quarter of the fund is made up of emerging markets like China, India, and Brazil. Emerging markets can be risky, but at times are known to provide greater returns than developed regions. If you're invested with Fidelity, I would recommend the Fidelity Total International Index Fund, FTIHX. The fund tracks the MSCI All-Country World Index, excluding the US, and represents approximately 5,000 international companies. It has an expense ratio of 0.06%, and the fund composition is very similar to Vanguard's Total International Stock Index Fund, VTIAX. It holds a good balance of developed and emerging markets, and the bonus is that it's actually cheaper with a 0.06% expense ratio versus a 0.11%. If you're invested with Charles Schwab, I would recommend the Schwab International Index Fund, also known as SWISX. This fund is slightly different from the two that we just discussed so far because it's primarily focused on developed markets like Japan, United Kingdom, and France. Specifically, largest companies across 21 developed markets in Europe, Australasia, and the Far East. Charles Schwab unfortunately doesn't have a good low-cost international index fund that tracks both the developed and emerging markets. The funds that somewhat do are actively managed funds with high expense ratio, and I personally wouldn't recommend them. It represents approximately 800 international companies from developed nations and has an expense ratio of 0.06%. Again, just for kicks, let's compare the historical performance of these three funds. Given the constraints of the data, we can only go back 6 years to 2017. Not a good time frame, but we're just doing it for fun, so what the heck. The past 6-year performance are as follows. The Vanguard Total International Stock Index Fund at 5.96%. The Fidelity Total International Index Fund at 5.88%. The Schwab International Index Fund at 6.51%. Some variance, but not too much. We can see the Schwab International Index Fund is slightly better than the other two, given its focus on developed markets, but that could change in the future. Alright, I covered a lot in this video, so let me do a quick recap of all the funds I recommend. When it comes to best total market index funds, the Vanguard Total Stock Market Index Fund, also known as VTSAX. The Fidelity Total Market Index Fund, also known as FSKAX. The Fidelity Zero Total Market Index Fund, also known as FZROX. The Schwab Total Stock Market Index Fund, also known as SWTSX. When it comes to best S&P 500 large cap index funds, the Vanguard 500 Index Fund, also known as VFIAX. The Fidelity 500 Index Fund, also known as FXAIX. The Schwab S&P 500 Index Fund, also known as SWPPX. When it comes to best international funds to spice up our portfolio dish, the Vanguard Total International Stock Index Fund, also known as VTIAX. The Fidelity Total International Index Fund, also known as FTIHX. the Schwab International Index Fund, also known as SWISX. All these are excellent broad market, low-cost index funds, and you really can't go wrong with any one of them. Select either a total market or the S&P 500 fund and hold it as your core equities holding. Then add as much or as little of international funds to augment your portfolio as you like. Thank you guys for watching. If you'd like to know more about how to build your own 3-fund portfolio using these funds, please check out my video here. Until next time, all the best.